Good afternoon. Thank you to our investment committee members for being here this afternoon. For those of you who are joining us for the first time, I'm Simone Nelson. I'm the managing director of the Mosaic Fund. With me, I have some of my colleagues, Anne, our in-house economist, Faison, our portfolio manager, and some of our acquisition analysts, Jimmy, Zach, and Juan. So to guide our discussion this afternoon, I'd like to bring a brief overview. As you know, we are looking for our Fund 5, and the opportunity has been presented to us to join the Northern Lakewood Fund investment. We will be analyzing this holistically in terms of where it sits within the greater macro environment, where the deal financials fit within our greater fund objectives, the risks and potential benefits that this investment brings to us, and in the end, hopefully present a conclusion to you and our final suggestion. So as I mentioned, we are looking at this investment holistically, and we chose a top-down approach. We are looking at it in terms of the greater affordability crisis within the US real estate market, the ever-evolving and changing regulatory environment in which the investment sits, the partner who has brought us this potential investment, and then the greater deal financials. To speak further about the drivers of this deal, I'd like to invite my colleague Faison.
Thank you, Simone, and thank you everyone for being here. We are here today to request a $113 million equity investment, and with this investment, we expect to achieve an 11.7% levered IRR for the fund. We are able to achieve these accretive returns through a lucrative property tax abatement program through Northern Lakewood, which drops our property tax liability from 20% of revenue to 3% of revenue. This is for 40 years, so it's accretive not just to us, but to our partner that we exit with. In exchange for this property tax abatement, we are going to convert 2/3 of the 1,000 units to affordable. And in addition to driving the accretive returns, the affordable aspect of this is actually a great late cycle investment. And we see this as a defensive asset class to park our capital in. In the case of an inevitable downturn, the need for affordable housing is only going to increase. In addition, we're a core fund, so producing income is of utmost priority to us, and these durable cash flows start at day one. In addition, we generate a lot of social good, and this complements some of the regulatory pressures in effect in Northern Lakewood. And in addition, this isn't just anywhere. Northern Lakewood is a core top 5 market within the US. There's a lot of tenant demand drivers, so there's a new hospital that opened up. There's a lot of TAMI firms that operate in the area, and affordability is low. And then lastly, our strong operating partner is definitely an asset because affordability and affordable housing has a lot of tax and regulatory implications. So our partner has expertise in this area, not just anywhere, but in Northern Lakewood. So even though this is a great investment, it also hits on a lot of our fund objectives as well. In terms of timing, we're sort of up against a wall right now. We have to deploy $425 million of capital within the next 18 months. With a $113 million investment, we chip away at about a quarter of this. And we do this within 5 years. So we have to exit all our fund holdings by 2025. So with a 5-year hold, we won't have to pull our 2 1-year extensions. As a fund, we also target an overall return of 12 to 14% levered IRR. And I know you guys are thinking that 11.7 is sort of at the low end of that, but we've hit some home runs earlier in the fund life cycle, so I'm comfortable that we'll be able to achieve these targets. And in addition, we have a 1.7 equity multiple that exceeds the 1.5 threshold set by our investment partners. In terms of debt, we try to have a fund-wide target of 60 to 65% of our fund holdings. And right now we're at about 55%. So I actually like the team proposed a 70% LTV, and with cheap debt financing, we've got the debt at great terms. Lastly, while we are a returns-driven fund, the social implications of this deal are great for some of our partners. As you know, LPs are putting a lot more emphasis on ESG. So by earning some of this social goodwill, we think it'll help with the fundraising for Mosaic Fund 6. So when we were evaluating opportunities to invest in, we took a top-down approach and considered the macroeconomic environment as well. And what we found is that what's happening in Northern Lakewood is happening across the US. As more and more people move to urban city centers, which you can see 84% of the population right now in the US lives in the city, as that increases, it puts upward pressures on rent. And you can see since the 1960s, rents increased by 60% while wages have sort of stagnated. And we only see this problem exacerbating. So with this huge demand driver, the only way to achieve some parity is with supply. But supply is extremely constrained as well. Right now, development costs are sky high, and a lot of it's driven by construction pricing, which has increased year over year. Land availability and pricing has also increased in tandem with that. And municipalities have started taking an approach to try and address these issues, but actually they've had the opposite intended effect. So items like stricter zoning and rent control have only served to dampen development demand on behalf of developers, so supply is actually sort of stagnated as well. And with that, Anne's going to dive into some more of the public and private initiatives that are taking place to address these issues.
Thanks, Faison. So, in light of these trends that Faison has mentioned, firms within the private sector are utilizing innovations to address this affordability issue. Firms are increasing their rent per square footage while also providing more affordable housing opportunities. And we're seeing this be done through innovations such as micro-units. They are decreasing the size of their units while allowing tenants to come in at a lower price point. And we're seeing these rise in popularity quickly. More than 20,000 micro-units have been built since 2008. And we've also seen a rise in popularity among co-living. More than 3,300 co-living properties have been built in the past 5 years, and there's been a $2 billion increase in co-living investments within the past year alone. Additionally, we've seen an 8% CAGR of new manufactured housing shipments since 2013. Institutional investors are also creating opportunities to alleviate this issue through affordable housing funds to build or rehabilitate multifamily apartments. And this project is a perfect example of this because 512 Development Partners is backed by a $500 million fund that is solely dedicated to delivering affordable housing units. Now, we're also seeing the government stepping in, and we're seeing them emerge in two different ways. Some are promoting affordable investment, and others are limiting rental increases. And on the promotional side, we see multiple tax incentives, which we're able to take advantage of with this particular investment. We've also seen the National Low-Income Housing Tax Credit rise 15% within the past year in order to address this issue and promote further investment. And on the flip side, government regulation is limiting rent growth and in turn is stifling development. And we're seeing this be done through affordability requirements as well as rent control expansion. And these have already been modified in states such as New York, Oregon, and California, which has caused a stunt in growth across all of these markets. Now, how does this apply to Lakewood? Well, we believe Lakewood is an embodiment of all of these macro trends. As Faison mentioned earlier, home prices and rent prices continue to rise while wages remain relatively stagnant. This is forcing people to look for rent and preventing them to purchase homes. And so as we move along this cycle, we can see that because rents are so high, more and more people seek affordable options. So we do see a strong demand for Lakewood's affordable units. And because we're in this strong growing market, we may be more vulnerable to government regulations. However, this has brought in incentives. And the Lakewood portfolio utilizes this by converting 2/3 of their 1,000 units into affordable units in exchange for a property tax reduction from 20% of revenues to only 3% of revenues. And now I will hand it over to Zach, who will go into more of the financials and what they mean for this specific project.
Thank you, Anne. So we find that this investment is immediately accretive based off of our agreement with the municipality. The biggest benefit is that we're seeing a $5.7 million reduction in property taxes on year one. This is going to escalate as we make certain improvements and grow our revenue over the years relative to a situation where we leave everything as a market rate investment. The other thing that we see is a gradual decrease in rental rates relative to that affordable unit. As you can see, we only need to convert our units to affordable as individuals move out. Based off of historical information, about 15% of our market rate units turn over every year, and 3% of our voucher units are going to turn over every year. So as this progresses, by year 5, only about 20% of our units have actually converted to an affordability status, which results in just a 5% discount when you're looking at rental rates for an all market rate unit versus an affordable transaction. The other reason we love this transaction is that it has relatively low capital expenditure requirements. We're expecting to spend about $43 million over the life of the lease. This represents just 10% of the initial capital expenditure to purchase the asset. We also feel confident that there's been a significant amount of CapEx spent at the community so far over the last 5 years, about $60 million from the prior owner. Now, the other great thing is that this $43 million is split into 2 different buckets. Half of it is dedicated to just repairs and maintenance in common areas, but the other half is dedicated towards revenue-generating items. This includes utility savings, the ability for us to now charge back and get utility expenses, and then finally, we're going to renovate some of the assets, and resulting in a $250 per month premium relative to the pre-existing rent. And how are we going to source this? Well, the majority of it is actually coming from in the way of a seller credit for work that has not yet been completed. And then, of course, is also just through the cash flows themselves that we are receiving. As we look to our total returns, we like this investment because it really is yielding cash right away. We see that the income yield based off our cost basis is over 4.5% from year 1. Now, the CapEx spend is going to be a little bit more meaningful in the first 2 years as we carry out those renovations, but it really depletes over the final 3. This results in a 6.5% project-level unlevered IRR. Then when we apply debt to this, we got really attractive rates at 3.5% interest at a 70% LTV. And we benefit further from some of the cogen work that we are putting in place here. This results in a 13.2% levered IRR at the project level. Again, this is an income-producing asset where income yields by the exit in year 5 are over 5%, which results in a 43 basis point spread over the cap rates that we expect at that point. With this, I'm going to hand it over to Juan, who's going to talk a little bit about the JV structure and what it means for our returns.
Thank you, Zach. We're offering a 20/80 equity split between the JP and the GP and the LP, with a 10% promote over a 10% hurdle, with 20 additional points over a 14% hurdle. Now, we're cognizant that this is different from the 50/50 equity split that they were proposing initially. However, we're confident that with our waterfall structure, the GP will be incentivized to accept our offer. Furthermore, this will allow us to deploy a larger amount of capital, considering that we need to invest $425 million over the following 18 months. Now, getting into more detail of what this represents for our investment, by increasing our equity split, we would pass from moving $70 million to investing $113 million. We're keeping our returns constant. However, the JP would increase their returns from 14.8% to 19.1%, while their equity multiple would increase from 1.91 to 2.21. Now, I'll hand it back to Zach to talk about some of the risks that we have identified in the execution perspective.
Thank you, Juan. So, of course, there's going to be some major risks that we need to consider from an execution standpoint. The first piece is CapEx overruns. These can have an impact on our returns, but we are confident that this is really just a minor piece of this overall investment, which gives us more comfort about this execution. Finally, tenant turnover. This is something that is a major concern as far as historical averages have been at 15%, but there's a chance that with converting to affordable, we may see increased turnover, which would diminish returns. But again, we think that historical averages are going to maintain. The last few, asset age, asset amenization, and community disturbance, we think are going to be comforted by the fact that we're converting this to an affordable unit, and it's going to be less impacted. Now, we wanted to quantify these risks. What does it actually mean to our returns as the LP? So first, we looked at turnover. What happens if this increases to 50%? Well, we find that this is going to result in a 160 basis point reduction to LP returns. Then we looked at the renovation premium. What happens if instead of being $250 at home, it's 10% less than that? This is going to result in just a 30 basis point reduction in our returns. As far as CapEx overruns, if we are 10% above budget, that'll result in a 50 basis point reduction to our LP. And then finally, exit. Of course, this is a crapshoot. We're not exactly going to know what's going to happen, but we projected if we're at a 5.25% exit cap rate compared to the 4.75 that we expect, it'll reduce our returns by 170 basis points. Now I'm going to pass this on to Jimmy, who's going to talk about some of the other risks that we might take.
Thank you, Zach. So as with any project, the GP is a major portion of it. Who are you going to partner with? And this one is no exception. We've identified several risks associated with the GP, and kind of quickly run through them. First one, we never worked with them before. So we want to be able to understand that there are going to be some growing pains with the new owner, a new operator for us, and just getting to know each other. Second one is total GP responsibility. They're going to be highly involved in this project, and we have to be able to be comfortable that they're going to execute. Next, we have the co-investment with a separate fund. Typically, they don't work with other funds, but I think in this case, it's very minor. The largest risk we've identified is a lack of control. 512 has expressed interest in control over all major decisions, and it's something that we have to be able to understand and mitigate. Next, misalignment of interests. As with any project, you always have to worry about this, and it's something that we'll focus on in a second. Last, excessive GC fees. So a little bit higher than what we're used to, but again, we think we are comfortable with it. Now, how do we get comfortable with that? Despite all of these, we think that 512 is a phenomenal partner for us. They have almost 30 years experience in this area doing renovations like these with another fund. And that fund they're so invested in this area that it prices them out. They don't have the concentration requirements, so they can't be in this, which is why the deal came to us in the first place, which we think is really, really good. And they are such a strong partner. It's a great opportunity for us to grow our base with other GPs and understand better the area and the partner itself. So how do we marry these risks and this really great operating partner? And that boils down to our JV agreement. As Juan mentioned before, we are going to change the equity split. We think that will help align our fund goals with the GP as well. Also the waterfall, helping to understand where the promote works, how do we make sure that they want to make our returns the best as well. In terms of control, we participate reorganizing the JV to give them some control, but not all, and something that we'll have to negotiate going forward. And finally, with the hold period, it aligns very well with our fund, and we would also like to ask for exit optionality to further align. Now I'd like to turn it back over to Simone to talk about the regulatory risks.
Thank you so much, Jimmy. All right, so as I mentioned, there are a number of concerns that are very unique to the environment in which we're presenting this investment. One of them is we do need to maintain the city affordability rules, which are underpinning to our financials, as well as the tax abatement regime, which allow us to achieve these kind of returns for our investors. Those are the two largest, and obviously they are based in the government policies, so we would just have to keep that in mind as we proceed into due diligence. That being said, I'd like to present the committee with this investment and suggest we move ahead into the due diligence phase. We find it a very strong defensive holding, given where we sit in the late cycle. We find that it does throw off social good, which is of interest to a number of our LPs. We are getting a first look at this, so it's not too competitive a landscape for this investment at this time. It is a strong partner. They do have particular expertise in this asset class, and we would find them that we would both benefit as well as them. And it does throw off very strong, compelling returns for our investors. So at this time, we would like to suggest that we move forward into due diligence and proceed with the deal. And I'd also like to open up the floor now to discussion and any questions our investment committee might have for us.
Yeah, sure. You did miss a slide. The fees that we have in place are acquisition fees of 1%. If you go back to, I think there's one of the slides, you can see like the equity breakdown. Even in a 50-50 scenario, they're contributing part of those fees towards equity. And so that is layered into our returns. 1% acquisition fee. And then promoted structure beyond that.
Yes, ma'am.
So We like the fact that they're coming in with 50-50 terms, but that's not the way that we conduct business. As a fund, we typically come in between 80 to 100% of the equity. One way of incentivizing them is increasing their returns. So as Juan and Zach showed, their GP level returns increase from like mid-14s to mid-19s. So really quantifying that impact, and then also we kept our returns constant. So it's more of a negotiating / signaling tactic with them to show that we're putting in the equity not from a returns-based perspective, but really just to get our capital out there. And if anything, as a GP, they should, from my, putting ourselves in their shoes, this frees up capital on their end to spend on other deals.
Yeah, I would also maybe just add that they have concentration requirements, so they want to get significant returns, and they're getting, based off our structure, they're getting very healthy IRRs. So they should be comfortable with this investment, and that concentration requirement really enables them to invest that elsewhere. So they might be also amicable to having a lower investment in the deal.
We are at the table. We want to negotiate. This is an area and a market that we see a lot of potential in. It's top 5.
Yeah, I would say absolutely we can still do the deal because we're still getting healthy returns in either scenario, but we're just facing this as far as we need to deploy $425 million over the next 18 months. So if we can put out $70 million, that's great, but if we can put out $113 million, that's even better from our perspective.
We're a national level investor. So Northern Lakewood is one aspect of our entire portfolio. We don't have, at this time, our fund isn't investing in other assets in this area. A couple of things that really stand out. Right now, our fund is mostly office heavy. So the multifamily aspect balances that. So it's not just location diversity that we're seeking, but we're also seeking asset class diversity. We also don't have any affordable housing assets in our portfolio. So we get diversity through that as well.
Well, one of the reasons why we are selling this asset for 4.75 cap rate is the fact that we haven't changed all the units. The cap rates of these markets are 3.25, so that's one of the reasons why the cap rates are higher. Furthermore, we did underwrite the fact that we may sell this asset with a higher cap rate, so part of the mitigation of that would be the underwriting of that aspect of the
We also wanted to structure the deal, I pointed out, to have exit optionality. So we have a ROFO or continuing, push the close if we wanted to. So give us that optionality if we like it and it's performing, or however we want to exit.
Yeah, I mean, so our sensitivities do not include that, but it would have an impact on our returns as well. I mean, going from 3 to 6% it can be a meaningful number as well. But again, these are voucher units. That's not changing. So I don't really think there's too much of a reason that these individuals, that we're going to see too much change from historical averages for the voucher unit individuals.
It's also less of an impact. We sensitize this variable because the impact is worse. So if there is an impact on the voucher conversions, then it would be less of a hit to our returns.
So the total was $1.7 million a year. So it's about $170 a year is what they're going to be. That's going to be the increased load for them. Thank you all.
Thank you very much.